accounting, we're answering the question, how are we doing? So in real time, we're helping management run the business. And one of the first questions that's often asked in a managerial accounting class is, how much did it cost to make our stuff? So for a manufacturer, we're going to keep track of the flow of costs as they go from materials, labor, and overhead into work in process, where we work on them, then we finish them, and then we sell them. And hopefully we sell them for more than what it costs us to make them. Let's look at a sample problem from a textbook. As I say, keeping track of how much it costs to make our stuff involves tracking materials, labor, and overhead as it goes into work in process. Then from work in process, we finish it, and it sits in our finished goods warehouse where it accumulates no more costs. And then eventually we sell it for more than what it costs us. And that's when those dollars actually hit our income statement as the expense called cost of goods sold. And one of the ways that textbook authors try to teach us this flow of costs is by giving us some of the numbers and asking us to puzzle out what the remaining numbers are. This one gives us two cases. Today we're going to focus on case one. It gives us some of the numbers and asks us to figure out what the others are. It also asks us to create a condensed cost of goods manufactured schedule, which means show us what happened in the work in process account. And then it asks us to prepare an income statement. Remember, an income statement is revenue minus expenses. It covers a period of time. It's our report card. Did we make money or did we lose money? And then it asks us to create the current assets section of the balance sheet. Remember, the balance sheet is what we own versus what we owe. And in this case, we're supposed to tell the world the current assets we have, stuff that is cash or will be cash within the next year. I'm going to solve this problem using these T accounts. And if you don't remember what T accounts are, I'll put a web address to a 3-minute video I have about what T accounts are. And this is the information that the problem gives us. We use $9,600 in raw materials. We use $5,000 in direct labor. We used $8,000 in overhead. In this example, I'm going to assume that all overhead that was incurred got applied. Later on, we'll realize that there's rules for applying overhead, and it may not all get applied in every month, but this time, because we're just starting, let's assume that all $8,000 worth of overhead moved into work in process. It tells us that the beginning work in process, the stuff left over from last month, it has costs of $1,000. It tells us that the sales for the month were $24,500. Sales discounts, in other words, we told our customers, if you pay us early, you can take a 1% or a 2% discount. Those were $2,500, and it tells us that operating expenses were $2,500. It also tells us that the cost of goods manufactured, what we finished, is $17,000. And it tells us that the ending finished goods inventory is $3,400. The flow of costs in a manufacturing environment are simply moving stuff from the left-hand side to the right-hand side. If we use $9,600 worth of raw materials, where did it go? It went into work in process. If direct labor was $5,000, where did it go? It went into work in process. If we assume all manufacturing overhead got applied this month, where did it go? It all got applied to work in process. Well, if we started with $1,000 of work in process, added materials, labor, and overhead of $9,600, $5,000, $8,000 respectively, and it told us that we finished, our cost of goods manufactured is $17,000. That means the balance here in work in process at the end of the month must be $6,600. And I'm going to put in bold the stuff that we figured out. It tells us that the goods available for sale are $22,000. So we had in our finished goods warehouse, before we sold anything else, goods available for sale of $22,000. Well, if $17,000 came in, that means that our beginning balance in finished goods inventory must have been $5,000. So that $5,000 that was in there from last month, plus the $17,000 we finished this month, gave us goods available for sale of $22,000. It tells us the ending finished goods inventory was $3,400. So 5,000 plus 17 minus 3,400 means that we must have transferred out 18,600. That's our cost of goods sold. So we've got three inventory counts: stuff we're going to work on, stuff we're working on, stuff we're finished working on, and our income statement account, our cost of goods sold, must be $18,600. The problem asks us for a condensed cost of goods manufactured schedule, and as I said earlier, that's just a schedule that shows what happened to work in process. We started with $1,000. We added direct materials of $9,600, labor of $5,000, overhead of $8,000, which means that we had a total of $22,600. That means our total cost of work in process is $20,600 minus the $6,600 balance, gives us cost of goods manufactured, what we finished, of $17,000. We call it condensed because if you wanted to get fancier or more complete, instead of just showing this $9,600 for materials, for example, you might say our beginning balance was X, we bought Y, we had Z left, so we must have transferred out $9,600. You also might list out all the various components of manufacturing overhead. But this is the condensed version, so it's nice and simple and straightforward and really just tells you what happened to the work in process account. Next, the problem wants an income statement. Well, it told us the sales were $24,500, sales discounts are $2,500. In other words, we told our customers if they pay us early, they can take a discount. So our net sales are $22,000. We just figured out our cost of goods sold is $18,600. That gives us gross profit of $3,400. Remember, net sales minus cost of goods sold gives us gross profit. How much do we mark our stuff up? Because the whole point of being in the manufacturing business is to make something for X dollars and sell it for more than X dollars. Well, that's that more than X dollars. $3,400. It tells us operating expenses were $2,500. Operating expenses are things like rent on the corporate offices, sales commissions, things like that. So revenue minus expenses gives us operating income of $900. Lastly, we're supposed to prepare the current assets section of the balance sheet. The balance sheet is what we own versus what we owe. It tells us that we have $3,000 worth of cash. It tells us that we have invoices out unpaid for $15,000. That's account receivable. It tells us that prepaids, things like next month's insurance expense, are $400. We paid that earlier. And then, as I say, we have three kinds of inventory. Stuff we're going to work on, and the problem tells us that the ending raw materials inventory is $600. And stuff we're working on, that's the $6,600. And the stuff we're finished working on, that's the $3,400. That gives us a total of current assets, stuff that is cash or will be cash within the next year, of $29,000. In summary, the flow of costs in manufacturing environment are materials, labor, and overhead flow into work in process. Work in process flows into finished goods. Those costs sit there. They don't gather any more costs at that point. And then they are sold for hopefully more than what it costs us to make them. And that's really all there is to the flow of costs. Unfortunately, one of the ways that textbooks try to teach us this flow of costs is giving us these incomplete manufacturing costs and expenses and selling data and fill this in like a giant puzzle. I hope that helps.